Well, stock futures pulling back this morning as investors look towards econ data and big tech earnings. We will be getting a number of readings on the economy this week, but the big focal point is going to be the first estimate of third quarter GDP and the Fed's favorite inflation gauge, PCE. So as the Fed continues to drive home that rates will likely need to stay higher for longer, any good news for the economy has sent jitters through the markets as of late. And then for earnings, big tech results on deck. The hype around AI has been the big driver for the sector so far this year. And analysts, well, they expect that trend to continue. So here with more on how investors can best navigate the week ahead and the months ahead, we want to bring in Brad McMillan. He is Commonwealth Financial Network Chief Investment Officer. Brad, it's good to see you. Lots to unpack there. Clearly a heavy week in terms of econ data and also for earnings reports. But let's start with the move that we're seeing in the yield. That was the big news out this morning, just that brief move above 5% in the 10-year. How are you looking at that from a strategist standpoint?
Well, you're certainly right. Moving above 5% is a major barrier. We haven't been there since before the financial crisis, and it's a big round number. It's a big round number. So people are going to get scared. From a little bit more factual standpoint, we notice that stock valuations tend to be positively correlated with yields up to about 5% and then negative thereafter. So there's a real reason to start thinking this is going to have an impact. But at the same time, when you look at valuations, almost all of the S&P 500 stocks are still fairly reasonably valued. The exception are the big seven. So when you look at that from a valuation, from a yield standpoint, the risk isn't nearly as great as people might think.
What are the typical characteristics, Brad, of a high yield economy or some of the larger impacts?
Well, I want to give you a couple of different angles on this because we focused a lot on the negatives here. And when we talk about high yields, we're talking about mortgage rates. That's hurting the housing market. Okay, that's a negative. We're talking about the ability of companies to refinance debt. That's a negative. But on the other hand, you have, and most of the homeowners now have mortgages that are at low rates. They still have spending money. They're not affected by the higher rates yet. So there's no impact there. You look at people who have fixed income investments, they have more money. They can spend more. So it goes both ways. My personal take is this is going to end up being positive. We move back to a normal rate environment. I think the positives from the savers are going to overwhelm the negatives from the refinancing aspects.
Brad, what's been your takeaway from earnings season so far? 73% of the companies that have reported better than expected profits. That's just below that 5-year average. We'll certainly get a better look at the tech sector this coming week with the number of the Magnificent Seven stocks, which people have loved to call it here over the next couple of days. But what do you, in terms of the takeaway that we've seen so far, what does that then signal just about consumer behavior? What it signals about how sensitive some consumers are to higher rates, to inflation, and then how that's going to trickle down into some of these performances that we could expect to see over the coming quarters?
Let's take a step back, Seana, kind of in a macro way to look at it. Everyone's been talking for a recession. Everyone says things are slowing down. The jobs numbers aren't saying that. Consumer spending isn't saying that. Even consumer confidence is not saying that. So for all the death of the economy has been overpredicted for a long time, and I don't see that changing. Now, that said, what does that mean for earnings? People are still spending money. You look at the third quarter economic growth, that's expected to come in very strong. So are earnings more likely to outperform or underperform? Well, we know from history they're likely to outperform, and that's exactly what we're seeing. So I think there's upside potential for earnings. And I think the valuation pressure, as I said, is not nearly as bad as it might be. So I still see some upside into year end.
What is the theme that as companies start to give their outlooks for 2024, and we've seen so many things kind of jump to the top of the list of concerns for many CEOs of publicly traded companies, none more so than geopolitical tensions, at least according to KPMG's most recent CEO survey here. When you think about the top things that these CEOs are going to be forecasting going into next year, what's the theme that you expect to prevail?
I think right now, trade and geopolitics is what's affecting most large companies. When you look at the deglobalization trend, when you look at relations between China and the rest of the world, because that's the big one, I think you certainly have that vulnerability. And then when you look at the Middle East, you also have an energy vulnerability, and that could have a systemic effect. So I think those are the two biggest issues CEOs are going to be concerned with. But again, I think what they're trying to do is they're trying to highlight all of the risks and very appropriately so. But even as they highlight them, they're working to mitigate them. And I think that'll end up being the big story for 2024.
Brad, we got to go. Do you have a top pick going into 2024?
I like energy a lot. We have deals going on. We have the potential for growth. We have a managed supply structure. That's not a bad place to be if you're an investor.
Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Thanks so much for taking the time here to kick off the week with us.
Thank you, Brad.